Stagflation is a difficult economic situation. It happens when inflation is high, economic growth is slow, and unemployment is high. This combination creates a challenging environment for policymakers and individuals alike. High inflation erodes purchasing power, making it harder for people to afford goods and services. Slow economic growth limits job opportunities and income potential. High unemployment further exacerbates these problems, creating a vicious cycle. Stagflation presents a dilemma for central banks. Traditionally, they use interest rates to manage the economy. They lower rates to stimulate growth and raise them to combat inflation. However, stagflation makes it difficult to address both issues simultaneously. Lowering interest rates to boost growth could worsen inflation. Conversely, raising rates to curb inflation could further stifle economic growth and increase unemployment. The consequences of stagflation can be severe. Businesses face shrinking profits as costs rise and demand weakens. Consumers struggle with rising prices and job insecurity. Governments grapple with declining tax revenues and increased demand for social safety net programs. Stagflation can lead to social unrest and political instability as people become frustrated with the government's inability to address the situation effectively. The 1970s offer a stark example of stagflation's impact. The decade began with rising inflation, fueled by expansionary monetary policy and increased government spending. The situation worsened in 1973 when the Organization of Arab Petroleum Exporting Countries, OAPEC, imposed an oil embargo, causing oil prices to skyrocket. This supply shock sent inflation soaring further while simultaneously pushing the economy into a recession. The United States experienced its worst stagflation during this period. Inflation peaked at over 13% in 1979, while unemployment reached nearly 9%. The Federal Reserve struggled to control the situation. Initially, it lowered interest rates to combat the recession, but this only fueled inflation. Later, it raised rates sharply to curb inflation, but this contributed to a deeper recession. The 1970s stagflation had a lasting impact on economic thinking and policy. It highlighted the limitations of traditional macroeconomic models and the need for new approaches to address supply-side shocks. The experience also underscored the importance of a credible and independent central bank to manage inflation expectations effectively. As of May 2025, the global economy is facing renewed concerns about stagflation. While the current situation differs from the 1970s, several warning signs have emerged. Inflation, although not as rampant as in the 1970s, has been stickier than anticipated. The Consumer Price Index, CPI, indicates a 3% year-over-year increase in January 2025, surpassing the projected 2.9%. Simultaneously, economic growth has been sluggish. The International Monetary Fund, IMF, forecasts global GDP growth to slow to 2.8% in 2025, down from 3.4% in 2024. This slowdown reflects persistent supply chain disruptions, geopolitical uncertainties, and the lingering effects of the COVID-19 pandemic. Adding to the concerns, unemployment, while historically low, is showing signs of ticking upward. The U.S. unemployment rate is projected to rise to 4.4% by the end of 2025, up from 4.1%. This uptick, coupled with slowing wage growth, could further dampen consumer spending and economic activity. Economists and market analysts are divided on the likelihood of full-blown stagflation in 2025. Some experts, like Barry Bannister of Stifel, predict a 10% stock market decline by year-end due to stagflationary pressures. Others, such as Joe Brusuelas of RSM, anticipate a milder stagflation-light scenario. The Federal Reserve faces a delicate balancing act. It must weigh the risks of persistent inflation against the potential for its actions to stifle economic growth and exacerbate unemployment. Fed Chair Jerome Powell has acknowledged the challenges of a stagflationary environment, but maintains that the current situation is not comparable to the severity of the 1970s. The path forward remains uncertain. Addressing supply chain bottlenecks, fostering innovation, and promoting sustainable economic policies will be crucial to mitigating stagflation risks. Governments and central banks must work together to navigate this complex economic landscape and ensure a stable and prosperous future.